Yesterday, the United States federal government passed a short-term spending bill that will allow the federal government to stay open through February of 2022. The bill was passed just one day before the actual deadline, and it approves any and all gaps in funding, like I said, through February of 2022. And it was passed in both chambers of Congress. And honestly, this happens all the time with the federal government. The federal government has shut down before, and most recently, it shut down in 2018 and for the beginning parts of 2019. And when the government shuts down, that comes at a huge cost. On average, a government shutdown can cost around $1.8 billion. In 2018 and 2019, that government shutdown cost around $5 billion. And as you can probably guess, this all comes down to the budget. Congress fights over what our spending budget should be for the following fiscal year. They do this every single year, and it decides how everything in the United States is going to get funded. And the reason Congress fights about how much we should be spending is because the United States government is in debt. Why does it really matter if the United States is in debt? If the government shuts down, what does that really mean? Does that really mean anything? And can the United States government continue to just be in debt? I mean, why can't our budget just be whatever we want? Does it really matter? We are going to break all of this down and more today, but before we get into all of that, my name is Nate from Minority Mindset News, and if you like this video, then smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world, and we can keep making videos just like this one. It is no secret that the United States government, the United States federal government, is in debt. And they have been in debt pretty much since they were founded. But what does being in debt actually mean? When you are in debt, that means you are borrowing money from someone else, and you have to pay that money back. You do this, and so does the federal government. The federal government can borrow money in a variety of different ways. Sometimes it can borrow money from other countries, and sometimes it can borrow money from investors. In addition, the Federal Reserve controls our monetary supply in the United States, and in doing so, they decide how much money is printed. But the United States government is in kind of a unique situation here, because our government is a non-profit entity, which means it has no way of actually making any money. The way our government gets money is from you, by taxing you. Taxes fund just about everything. So when the federal government comes up with these new spending bills, they have taxes to show how they will actually spend all of this money. Typically, though, there is a budget deficit within our spending bills. A budget deficit simply means that the United States government is borrowing a lot more money than it can reasonably pay back right now. So the question here is, why is that really a problem? And the truth of the matter is, Congress has gone back and forth on this every single year since, well, we have been a country. But the bottom line is, it's tough to look at the United States debt like you would look at personal debt. When you are in debt, you need to pay that money back. That is exactly the same thing that happens with the federal government. However, the federal government is more than just one person. When the United States government takes on debt, this means that they're using that money to build the economy, and they're using that money to fund programs. This is why a lot of economists look at the national debt as a percentage of the nation's GDP. The higher GDP you have, the bigger your debt is going to be, at least in most cases. The reason for this is because as you grow as a country, you're going to need more money. And as you build your economy, that means your businesses and the people within your economy are getting more money. But that money has to come from somewhere. All of that money needs to be printed, and that money is used to fund more programs. But our gross domestic product, or GDP, is essentially the revenue that the entire United States is bringing in. Basically, how much money is the country making? As the country makes more, it can afford to spend more, which means it can afford to take on more debt. But over the last 20, 30, and even 40 years, the United States government has taken on an exceedingly large amount of debt. Our debt is now around $29 trillion. But the real question here is, does this really matter? Can the United States government default on all of this debt and essentially shut down for good? Well, the answer is kind of yes and no. Can the United States federal government default on its loans? Absolutely. If for whatever reason Congress did not approve a new debt ceiling, that would essentially mean that the United States is going into default. This is exactly what would happen if you defaulted on your loans. However, every single time this has happened, Congress has approved a new debt ceiling. This allows the United States to borrow more. And every single time, the United States continues to borrow more, and the debt doesn't ever really seem to matter. But in some cases, it definitely can. GDP, or gross domestic product, is helpful here because it shows how your businesses are performing in a country. It also shows how the economy is doing, and it shows how much money everyone is making. That is an important aspect to the federal government because it shows how much things can be taxed, and more importantly, how much businesses and people can be taxed. Taxing people at an affordable amount while borrowing at a reasonable amount means that the United States government can pay for all of its debts. However, when your GDP starts to shrink and you have rising debt throughout the country, well, that could mean a few different things. For one, if debt is rising in the United States, that means the Federal Reserve is printing way too much money. This can lead to very high levels of inflation. High levels of inflation can be bad for just about everyone. It can be bad for consumers because prices are rising very rapidly, and it can be bad for businesses because now they have to foot the bill for all of those extra costs. In addition, you'll see wages start to go up, and initially that sounds like a good thing, but they're only really fighting inflation here. This can lead to the Federal Reserve and our federal government trying to restrict spending throughout the country, raising interest rates and stopping a lot of economic programs so that way people have a lot less access to money. And over the last year or two, the United States debt has exploded, all while the United States was in a recession. So essentially what that means is the United States was printing so much money. They did this because of the pandemic that started in March of 2020. However, businesses, at least at first, were not making as much money and people weren't spending, at least in the beginning. The reason our debt exploded is because of all the economic stimulus. $3 to $5 trillion was initially printed to lift the country out of the financial mess that was caused by the pandemic. The Federal Reserve did a lot of other things too. There were programs to help Wall Street, and they dropped their benchmark interest rates to near zero. All of this incentivized people to spend more, so all of this debt wouldn't affect the economy as much. But the other thing that you can see happen is the United States government doesn't take on as many bills, meaning that your economy and all of your programs within the country won't grow either. And these are things that a lot of people rely on, things like Social Security and healthcare and infrastructure programs that are vital to our nation's success. But like I said, if the national debt gets way out of control when compared to our GDP, the amount that we're actually bringing in, that could mean that inflation gets out of control too, and the Federal Reserve will raise interest rates. They don't want people spending as much money anymore. They need a lot less money circulating throughout the economy, at least in the short term, while our debt and our GDP starts to pick back up and become equal. And as debt continues to rise, the United States government has to find new ways to pay for all of this debt. And they have gotten creative before. In the $1.2 trillion infrastructure program that was recently passed, that bill explored new ways to tax US citizens in order to fund it. It proposed giving the IRS a lot more oversight on how it taxes citizens. It also proposed new taxes on cryptocurrencies and a US driving tax. And to be clear, while the bill has passed, none of these things have been implemented yet, and they're likely to change over the next few years. But the bottom line here is that the United States government gets very creative when it comes to bringing in revenue. Basically, debt continues to rise because our country continues to grow. Now, this can be considered a good thing by some economists. However, if our debt gets way out of control, that means that spending is going to get slashed in the United States too, and you could see interest rates begin to rise, which could hurt every industry that has to do with loans. In addition, inflation could get out of control, which will hurt wages, and it will hurt spending again. Lastly, this could hurt the stock market. So when the United States government is in a budget deficit, it has to find that money somewhere. The way that it does this is by offering people treasury notes. Essentially, you can give the United States government extra money and they will pay you back with interest. As the United States borrows more money from its people, though, the interest rate gets even higher because they need people to give them more money in order to pay off all of this debt. This could ultimately hurt Wall Street because people will start turning more towards these treasury bonds instead of corporate bonds. Corporate bonds work in the exact same way, but the difference is you're giving money to a corporation and they will promise to pay all that money back to you with interest over a specified period of time. Problem is though, is these bonds can look a bit risky, meaning people will turn more towards the Treasury Department and the United States government, because the US government is not going to fail. However, some businesses that you're loaning money to could fail, and you may never see that money again. And like I said, taxes will need to go up in order to afford this new debt. The United States government has no other way to pay this debt off, so they'll have to find new ways to pay taxes. For you to pay taxes. And that causes fights in Congress. That's why a lot of times we see arguments over bills. 9 times out of 10, the arguments are over money and who is going to pay for them. But regardless, the United States government has $29 trillion in debt, and it just keeps borrowing and spending more and printing even more money. Now, throughout our nation's history, this hasn't really been a huge problem. However, a lot of economists and financial experts are asking how long that will last for. When will this start to become a problem? Well, and there's no real answer here because it really just depends on how large your country is and what kind of debt the country has. I mean, the United States government has $29 trillion in debt, and its GDP is also rising too. I mean, over the last year or two, our GDP has risen because of the pandemic. However, the Federal Reserve has also printed a lot more money than it ever has in such a short period of time. That will naturally cause inflation to rise, which means all of these businesses and all of the people within an economy are going to have to start paying more. If inflation gets way out of control, then you hit a period known as hyperinflation. Now, the Consumer Price Index for October showed that inflation is at around 6.2%. The Consumer Price Index essentially shows all of the different prices in every industry and how they are changing from month to month. On average, prices went up by around 6.2%. Typically, inflation is around 2 to 3% every single year. The Federal Reserve thinks that 2 to 3% is a healthy amount for our economy because as your economy grows, you put more money into it, and that sort of helps everyone. People are making more, businesses are making more too. But what happens when things get out of control and inflation starts to rise faster than your economic input? That means you have printed way too much money, and this is exactly why Congress dictates a budget every single year. If the United States could just print as much money as it wanted, I mean literally as much money to handle every single situation in the world, then we would hit a period of hyperinflation. Our dollars would be worth next to nothing. And some have asked, well, why is that really a problem? If something costs $10 and I have $10 to pay for it, I don't really care what the level of inflation is. As long as I have enough money to be able to afford things, it doesn't matter if I'm spending $1, $100, $500. But this issue is a lot bigger than that because it involves more than just your everyday shops and the money that you personally are using. At the end of the day, our money is paper. It really has no inherent value because literally all it is a piece of paper. The reason that our money has value is because we give it that value. People believe in the United States dollar. That gives it value all around the world. It's why so many nations have the US dollar as their reserve currency. In case their currency crashes or the world goes under, they will have the US dollar to protect them because the US dollar is valuable. But on the flip side though, if anyone can get any amounts of money at any point, well then what really gives it value anymore? If everybody has it and there is a ton of it out there, then nobody really cares about it. What they care about is the things that they can buy with it. So if we're talking international borders here, if the United States is making deals with other countries, or if companies are making deals with other international companies, then normally they would use US dollars, or they would use the most prominent currency, the most valuable currency. However, why would a company or person or country want to be paid in a currency that is not valuable? The answer is they wouldn't, and that affects everything throughout the world, and it affects you trying to spend your money at the grocery store. Ultimately, your money would become worthless. And why would a store be incentivized to use a currency that is worthless? The United States would need to adopt a new currency and have it be accepted in our borders, which would basically make it nearly impossible for the United States government to pay off its debt with US dollars. And if the US government can't pay off its debt, remember, it goes into default. And if there is no US government, that makes it even harder for you to use your US dollars, because one of the reasons why our money is valuable is because the United States government says it's valuable and they back it. Now, this issue is a lot more complicated than that, and inflation is a lot more complicated than that. But the bottom line here is that it's really, really hard to justify printing an unlimited amount of money. Because to be completely honest with you, if that was the solution, that is a pretty easy solution. And I think our leaders in Congress and in the federal government could figure that out. But they haven't. And that fact alone tells me that this might not be the solution here. But for now, the federal government has come up with a budget, and whether that budget is good or bad and is actually going to cover the things that they want is yet to be seen. Budget deficits happen all the time, and this is how Treasury note interest rates go up. And remember too, the federal government is not the only government of the United States. We have 50 other states in our country, and they all have their own governments too, and they can function for a little while by themselves, even if the federal government shuts down. I'm not really sure if the federal government will ever shut down and default on its debt, but it's something that potentially could happen. I mean, the percentage is higher than 0. It's pretty unlikely though. And that leaves us with the question of how much money can the United States borrow before it gets into trouble? We haven't yet figured that out. We don't really know how much the United States can borrow and how much money it can really print. Just to be clear, I talked about hyperinflation, but we are not in a state of hyperinflation right now. Inflation has been higher in the United States, like in the 70s and the 80s. Inflation was around 13%. That is double the accelerated rate that we're seeing right now. And even then, we were not in a state of hyperinflation. Hyperinflation means the value of your dollars are going so far down that your economy and government is about to crumble. We just don't know how much is too much right now. But one day, we will have the answer to that question, and that day is going to leave us all with a tough decision. But now I want to hear from you on this issue. What do you think about the United States essentially borrowing as much money as it wants and printing as much money as it wants? Can money printing be completely unlimited? Or is Congress right to be very careful about how much it sets in the budget? In addition, will the United States ever default on its loans, or will it continue to just raise its debt ceiling? Whatever your thoughts are, leave a comment below before you go. But that is it for today's Market Briefs video breakdown. Thank you so much for watching. If you like this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.